Have you ever wondered how businesses and investors keep track of their money when dealing with complex financial contracts? It all starts with a set of rules called Accounting Standard 11. When a company uses a forward contract to protect itself from price changes, which we call hedging, any extra cost or discount is spread out over the life of that contract. However, if they are just trading to make a quick profit, they do not spread those costs out and instead record gains or losses based on the market rates at the end of the year. Building on that idea, let's look at how individual clients handle their accounts for equity index and stock futures. The ICAI, or the Institute of Chartered Accountants of India, provides clear guidance for buyers and sellers, while brokers and clearing members treat these trades like normal share trading. You as a client must follow specific steps to record your transactions accurately in your books. Now that we understand who the rules apply to, let's talk about the first step in any trade, the initial margin. To start a futures contract, you must pay a deposit to your trading member. This is not the cost of the contract itself, but a security deposit that you record as a current asset in your balance sheet. If the market requires you to add more money later, you simply add those payments to the same account. To see how this works in a real world scenario, let's follow a trader named Mr. X. On March 5th, 2023, he starts a futures contract and pays an initial margin of 50,000 rupees. The very next day, on March 6th, 2023, the requirements change and he pays an additional 5,000 rupees. By March 7th, 2023, the market moves in his favor and 10,000 rupees are refunded to his bank account. Finally, on March 8th, 2023, he pays another 2,000 rupees to meet the new target. This shows how your margin account is constantly adjusted. While the initial margin is a deposit, the daily changes in market prices are handled through something called mark to market or MTM margin. Every day as prices go up or down, money is either paid out or received into your account. These daily settlements are tracked separately for each stock or index to make it easier to see if you are making a profit or a loss at any given time. Moving forward to the end of the financial year, we must apply the principle of prudence, which basically means being cautious with our numbers. If your daily settlement account shows, you must take that loss out of your profits immediately. However, if the account shows a profit that you have not actually cashed out yet, the rules say you should ignore it for now. This keeps your financial records honest and prepared for the worst. Now, let's look at what happens when a contract finally ends, which we call final settlement or squaring off. You calculate your total profit or loss by comparing the final price to your original contract price. If you have multiple contracts, you use a weighted average to find the result. Once the deal is finished, your initial margin deposit is released back to your bank account and the final profit or loss is moved to your P&L or profit and loss statement. But what if a client cannot pay what they owe? In the case of a default, the clearinghouse will close the contract immediately. Any money the client owes is taken from their initial margin deposit. If there is still money left over, it is returned. But if there is a shortfall, the client must pay the remaining balance. This ensures the rest of the market stays protected from one person's financial trouble. Now that we have covered futures, let's transition to the world of options. Options are a bit different because the buyer pays a fee called premium, while the seller receives that premium but must pay an initial margin. In the accounting books, the buyer records the premium as a current asset, while the seller has a liability until the contract is finished. Just like with futures, we must look at our open options when it is time for the balance sheet. If you are a buyer and the current market premium is lower than what you paid, you must record a loss for that difference. If you are a seller and the market premium has gone up, meaning it would cost you more to buy it back, you must also record a loss. Again, we only record the losses and ignore any potential gains until they are actually realized. Building on the life of an option, let's talk about the final settlement for contracts paid in cash. For the buyer, the initial premium they paid is finally marked as an expense, and any money they receive from exercising the option is marked as income. For the seller, the premium they received becomes their income, but any money they have to pay out to the buyer is recorded as a loss. In some cases, people prefer to settle their contracts with actual shares instead of cash. This is known as a delivery settle option. If the option is exercised, the buyer of a call option will receive the shares and pay cash at the agreed price. If it is a put option, the buyer will deliver the shares and receive the cash. Regardless of how the shares move, the original premium paid or received is still recorded in the profit and loss statement, just like a cash settlement. Now, let's shift our focus to the rules of the government regarding taxes. Since the Finance Act of 2005, trading derivatives on a recognized exchange is considered a non-speculative business. This is great news for traders because it means if you have a loss, you can use it to reduce the tax you owe on other income, though you cannot use it against your salary. You can even carry these losses forward for 8 assessment years if you file your tax return on time. Building on those tax rules, some investors have different requirements. For example, foreign portfolio investors or FPAs usually treat their trades as capital gains. If your total turnover is less than 2 crore rupees, you might even choose a simpler system called presumptive taxation, where you just pay tax on 6% of your total turnover without having to list every single expense. However, if your trading becomes very large, you might be required to have a formal tax audit. This is mandatory if your turnover exceeds 10 crore rupees. If your turnover is between 2 crore and 10 crore rupees, you only need an audit if your profits are less than 6% and you are not using the simpler presumptive tax system. Interestingly, if more than 95% of your transactions are digital You might not need an audit even with a high turnover. Finally, let's talk about the STT or the Securities Transaction Tax. This is a small tax that the exchange collects on every sale of a derivative. For futures, the seller pays 0.02% of the trade value. For options, the seller pays 0.10% of the premium. But if the option is actually exercised, the purchaser pays 0.125% of the settlement price. These small contributions help maintain a regulated and transparent market for everyone.